Energy is the lifeblood of the modern world. For decades, the United States has balanced on a knife's edge between energy independence and global vulnerability. But by early 2026, that balance was shattered. A perfect storm of geopolitical conflict and supply shocks sent prices skyrocketing, leaving millions to bear the cost. This is a detailed report on the state of the U.S. oil market, the surge in prices, and the deepening suffering of the American people. Before we dive into the data, please subscribe to our channel to stay updated on critical economic reports like this one. To understand the current crisis, we must first look back at the unprecedented boom that preceded it. Between 2024 and 2025, the U.S. reached a historic milestone. By August 2024, production hit 13.4 million barrels per day. The United States wasn't just competing, it was leading the world in output. This wasn't just about more rigs, it was about efficiency. AI-driven drilling and advanced fracking allowed operators to produce more with 5% fewer rigs. Throughout 2025, prices remained remarkably stable. Supply from non-OPEC nations outpaced demand, keeping costs manageable for the average consumer. The Permian Basin remained the engine of this growth, fueling a sense of security that would soon be tested by forces far beyond American borders. The 2026 shock draws haunting parallels to the energy crises of the past. To grasp the scale, we must look at the ghosts of 1973 and 2008. In 1973, an embargo crippled the U.S. economy. Today, while we produce more oil domestically, our reliance on global price benchmarks keeps us tethered to foreign turmoil. The 2008 peak proved that prices could hit levels previously thought impossible. In 2026, we are witnessing a similar surge, but with far less economic buffer. The shale revolution transformed the U.S. into a net exporter, yet the 2026 crisis reveals that production alone cannot insulate families from global market shocks. Everything changed in early 2026. A sharp escalation in Middle Eastern hostilities disrupted the fragile peace of the global energy market. The effective closure of the Strait of Hormuz, a choke point for a quarter of the world's oil, triggered an immediate and severe price shock. By March 2026, Brent crude prices surged past $100. In some markets, it briefly touched $119, a level not seen in years. Fear gripped the markets. Analysts warned that if the disruption persisted, prices could move toward $150 or even historic inflation-adjusted records. The Energy Information Administration was forced to significantly raise its price expectations, reflecting a new, more volatile reality for the remainder of the year. But for the average American, this wasn't just a matter of market data and forecasts. It was a direct hit to their livelihoods and their survival. Average retail gasoline prices, which were expected to stay low, instead spiked to nearly $4 per gallon by mid-March 2026. Economists call it the Rule of 10. For every $10 increase in the price of a barrel of oil, gasoline prices typically rise by about 30 cents per gallon. The jump from $60 to $100 per barrel represents a $150 billion reduction in total U.S. consumer spending over the course of a year. This burden is not shared equally. Lower-income households, who already spend a larger share of their earnings on basics, are feeling the heaviest impact. These families spend roughly 10% of their income on groceries and over 2% on fuel. When energy costs rise, they are forced to make impossible choices. The crisis extends beyond the passenger car. Diesel, the fuel that powers the U.S. supply chain, has seen even more aggressive price hikes. Higher diesel costs mean higher shipping rates. Every product on a shelf, from electronics to produce, now carries a hidden energy surcharge passed on to the consumer. From long-haul trucking to last-mile delivery, the cost of moving goods has skyrocketed, adding another layer of inflationary pressure to an already strained economy. The U.S. Strategic Petroleum Reserve, once a robust safety net, has become a central point of debate as its levels reached historic lows. Refilling the reserve at $100 prices presents a massive fiscal challenge, leaving the nation with less leverage during this critical geopolitical standoff. Energy security is national security. The 2026 crisis has laid bare the strategic vulnerabilities that remain despite our domestic production prowess. As gas prices climb, so do inflation perceptions. By early 2026, headline inflation was projected to surpass 4%, driven primarily by energy costs. This has created a severe dilemma for the Federal Reserve. High energy prices act like a tax on consumers, slowing growth, while simultaneously fueling inflation. By late 2026, markets began pricing in a 25% chance of an interest rate hike, a move that could combat inflation, but risk pushing the economy into a recession. Global players like OPEC Plus have maintained significant production cuts, choosing to prioritize market stability over increasing supply during this period of crisis. U.S. energy giants have also shifted their focus. Instead of growth at all costs, companies like ExxonMobil and Chevron are prioritizing technological efficiency and shareholder returns. Despite the volatility, new frontiers are opening. Offshore projects in the federal Gulf of Mexico are expected to push production to all-time highs by late 2026. New developments in Alaska and deepwater projects are part of a long-term strategy to bolster domestic supply, even as the immediate market suffers. While oil remains the greatest vulnerability, natural gas has emerged as a stabilizing force, anchoring the domestic power grid and international trade influence. Liquefied natural gas exports are projected to reach record levels, providing a buffer for the U.S. economy and extending American energy influence globally. The outlook for 2027 remains highly contingent on the resolution of global conflicts. If shipping lanes reopen, prices are expected to stabilize. Global inventories are expected to build again as production catches up with demand, potentially bringing Brent prices back down toward the mid-60s. To summarize our findings, first, the market has transitioned from a period of record stability to extreme volatility, driven by events in the Middle East. Second, the human cost is immense. The rapid spike in gasoline prices has acted as a massive tax on the American consumer, draining savings and reducing spending. And third, despite current suffering, the U.S. continues to strengthen its position as a global energy superpower through technological innovation and LNG exports. The situation is heading toward a critical crossroads. The choices made by policymakers and industry leaders today will determine the resilience of the U.S. for decades. Behind every data point and every market forecast is a family trying to make ends meet. The true measure of our energy security is their stability. Thank you for watching this detailed report. Please support our channel by liking the video, leaving a comment with your thoughts, and subscribing for more reports. Stay informed, stay prepared, and we will see you in the next documentary.